Welcome back. Let's talk about stop placement. You know, I'm frequently asked by many traders, Ed, how do I place my stop? And it is a very important question because stops are key. You know, risk management is the most important part of your trading, and stop placement is key to risk management. Yet, many traders, especially new traders, really don't know the methods used to place the stops. Well, why don't we cover some of these methods right now? And this way, we'll certainly have a full arsenal of ways to place stops, and we can actually even combine these methods to create even better stops. Now, we're going to cover 5 basic methods for placing stops here. Monetary method, support and resistance, also called the technical stop, volatility-based stops, something called 2-bar Charlie, and parabolic SAR. Now, before we get started, some key points about stops. We're going to place a stop on every trade. That's very important. We have to limit the risk. If we don't place a stop on any of our trades, then we're taking unlimited risk. So on every trade, we're going to limit the risk by placing a stop. Also very important, we're never going to loosen a stop. Now, what do I mean when I say that, loosen a stop? Well, loosening a stop is moving it farther away from the price. And that's not acceptable because it creates increased risk. We can tighten a stop, and you're going to see that in several of the methods. We will be tightening our stops, moving the stop closer to the price, but we are never going to be moving the stop farther away from the price. We are never going to loosen the stops. Also, we will always adhere to our money management rules when we're placing stops. And if you're not familiar, just go to the risk management section, which is a very, very important section. Just review that entire section because we have to live by those risk management rules. That's what keeps us safe. That's what keeps us out of trouble. Also, and I can't emphasize this enough, we're always going to reject trades that create too much risk. Now for the first method, the monetary stop. This is probably the most widely used and at the same time the least effective method of stop placement. Still, this is better than not using a stop at all. Now, most traders, when they're starting out, use a monetary stop. In other words, they'll say, Ed, I'm using a 30 pip stop, or Ed, I'm using a 40 pip stop. How many pips away should I place my stop is a question that I hear very frequently. Well, as I said, this is not an effective way to place your stop. It is better than not using a stop, however. I'd rather that you did this than not place a stop at all. A monetary stop is based on either a particular amount of money. Most commonly, it's based on a particular number of pips. And it can also be based on the percentage of account value. Now, referring back to the risk management section, we do have something called the maximum loss rule, where we limit our maximum loss to a percentage of the account value. But that doesn't mean that we use the percentage of the account value to place the stop. It's just telling us how far away we can place the stop at its greatest point, at its farthest point from the price. It doesn't give us the location of the stop. And to create a stop that way doesn't really make any sense. But normally it's the number of pips. I hear it all the time. Ed, how far away should I place the stop? How many pips? Now on this chart you can see that the trader is simply using a 30 pip stop. And really it doesn't make a lot of sense to use a particular number of pips. And the reason why is very simple. Different currency pairs have widely different volatilities. Okay, for example, Great Britain pound US dollar currency pair moves about 150 pips per day on average. It's pretty volatile. But the Euro Great Britain pound currency pair moves less than a third of that amount. It only moves about 40 pips a day. So if one currency pair is 3 times as volatile as the other, would a 30 pip stop make sense for both of those currency pairs? I'd say no. I mean, if a stop makes sense on one currency pair, there's no way that it could make sense for the other. Okay, so that's the monetary stop. Now, usually, again, traders that are using the monetary stop are using it because they don't really have other methods at their disposal. So let's take care of that right now. Let's take a look at another method. This is called the support resistance or technical method of placing a stop. For a technical stop, after a test of support, the trader is going to enter long above support and place a stop beneath support. And we're going to employ the 10% rule. You may remember that from the elevator, which was a strategy that we covered earlier. We're going to measure the range between support and resistance and place the entry order in an amount equivalent to 10% of the range above support. And when placing the stop, we're going to also use that 10% rule. We're going to place the stop an equivalent of 10% of the range beneath support. Now, depending on the size of the range, that could create a very wide stop. So we're going to reject any trade that creates an unacceptable level of risk. Once again, we're referring to the maximum loss rule from the risk management section. We're going to reverse this for shorts. In other words, we'll enter short after a test of resistance using the 10% rule, placing a stop 10% above resistance and entering 10% beneath resistance. On this chart, we can see the US dollar Canadian dollar currency pair is clearly in a range. You can see that resistance is at 117.50, where it's been tested numerous times. Support is in the general area of 114.50. So we could say that if we measure the range, if we subtract 114.50 from 117.50, that's going to leave us with a 300 pip range. 300 pips distance from support to resistance. So let's apply our 10% rule. 10% of 300 pips is 30 pips. So our entry order will be placed 30 pips above support, which is 114.50. So 114.50 plus 30 pips places our entry at 114.80. Also, we will place our stop at 114.20. And the reason for that is because, again, 10% of 300 is 30 pips. 114.50 is the support level. We subtract 30 pips from support, and we get 114.20. Okay, now, and again, if using this method creates too much risk, we're simply not going to place the trade to begin with. Now, you may be wondering, what about selling short? Can we apply the same technique and the same principles to a short sale? And the answer is yes, we certainly can. You can see here that we have the entry and the stop now for a short trade based on the resistance level of 117.50. The distance between support and resistance hasn't changed. It's still 300 pips. And 30 pips is still 10% of 300 pips. So our entry is 30 pips below 117.50. That puts our entry at 117.20. And our stop is 30 pips above 117.50. That puts our stop at 117.80. So you see, we can use that in either direction to buy or to sell, long or short. And that's essentially, in a nutshell, that is the technical approach to placing stops using support and resistance. Now, we don't need to think of these techniques in a vacuum. We can use more than one technique at a time, much in the same way that we have used different indicators to confirm each other in several of the strategies that we've used. We can also use different strategies for placing stops. We can use those to confirm each other as well. Now, the next method that I want to speak to you about is the volatility stop. Now, a volatility stop, this is a little bit more advanced, what we're going to do here is we're going to measure the volatility of the currency pair or any instrument that you happen to be trading. We're going to measure the volatility of that currency pair for the time frame that is being traded. So, if we're trading on the daily chart, then we're measuring the volatility of the daily chart. If we're trading on the hourly chart, then we're going to measure the volatility on the hourly chart. Now, the indicators that we use to measure volatility are volatility-based indicators such as ATR, average true range, which you may recall that we've used in several strategies so far, or Bollinger Bands. Bollinger Bands are also based on volatility, and it would be very common to use Bollinger Bands to determine your stop as well. Now, once we've determined the volatility, we're going to place a stop outside of the range of volatility. That makes sense. We don't want to be inside of the range of volatility. We want to be located outside of it. And of course, once again, I can't emphasize this enough, we're going to reject any trades that create too much risk. So here's a chart of Bollinger Bands, and you can see that most of the activity is contained within the bands. You see, let me just explain to you what Bollinger Bands actually are. A Bollinger Band is a moving average, usually a 20-period moving average, surrounded by bands. The moving average is invisible on this chart. What you see are the bands that are located 2 standard deviations above and 2 standard deviations below the moving average. Now, a standard deviation is a statistical measurement, and if we're using 2 standard deviations, which we are on this chart, that means that 95% of the activity should occur within the bands. This is key because if you think about it, if 95% of the activity occurs within the bands and we place our stop beyond the bands outside of that area, there's a pretty decent chance that our stop may not be hit. So by placing our stop outside of the range of volatility, outside of the Bollinger Bands, that increases the chances that our stop will not be hit. But I want to tell you also that it's also very possible that by placing your stop outside of the Bollinger Bands, depending on where the price is located, you could be creating too much risk, so always be on the lookout for that. Also, you could simply combine Bollinger Bands with a support resistance technique. In other words, perhaps you have a stop that is beneath support and also happens to be outside of the range of the Bollinger Bands for the time frame that you're trading. That would be a stop that is being confirmed by more than one method. Let's take a look at another way to do this. Average true range, or ATR, measures the range of the average range of a candle. And you can see on this chart, the average true range, the ATR, is 96 pips for this currency pair on the daily chart. Now, when trading the daily chart, I generally like to use a stop that is equal to half of the daily ATR. You may recall that from the FXED trend method. 1/2 of the daily ATR is one way that I commonly will place a stop. But what if I'm not trading on the daily chart? Perhaps I'm trading on the hourly chart. Then what? For the hourly chart, I will often use double the ATR or 1.5 times the ATR to place my stop. In this example, the hourly average true range for the same currency pair is 21 pips per candle. If I'm using double the average true range, that means my stop would be 42 pips away, or 2 times 21. I could also use 1.5 times ATR on the hourly chart if I want to use a closer stop. Really, you have to take a look at these things and see what works best for you. And once again, you can certainly combine average true range with a support resistance stop or with the Bollinger Bands. And everything that you do, all of that is going to be contained within your risk management. So once we have all of that going for us, we're much more likely to place an effective stop. Here's another method that I want to tell you about, This is a method that's commonly used in all forms of trading, stocks, futures. The two-bar Charlie method gets its name from a bar chart. Of course, nowadays, most traders use candlestick charts. It is a trailing stop method and is designed to be used when the market is trending. What we'll do is we're going to place the stop 10 pips beneath the low of the two most recently closed candles or bars. We will not use open candles when calculating the stops for this method. Now, why? How come I can't use an open candle? Well, we said that we're going to place our stop beneath the low of the candles. If the candle is still open, how can we know what the low is going to be? We don't know that yet, so we can't use it. But what I want you to do, we're going to take a look at a chart, and we're going to trail the stop using this technique. Now, as each subsequent candle closes, we're going to recalculate the low of the two most recently closed candles. For long trades, if the new two-bar low is higher than the previous two-bar low, we'll raise the stop so that it is located 10 pips beneath the new two-bar low. In other words, if the price is moving higher, we're moving it up, but we're keeping it underneath the low of the two most recently closed candles. And of course, if we're long, we're not going to lower the stop under any circumstances. Here's the chart. You can see arrows pointing to two candles that are next to each other. Let's assume that the trade begins there. The candle on the left has a low of 7236. The candle on the right has a low of 7239. Out of those two candles, the lower low is 7236. So we'll place our stop 10 pips lower at 7226. That will be the location of our stop. Now let's assume the next candle closes. Now we have two candles with lows of 7274 and 7239. The lower of those two candles, the lower low, is 7239. So we'll place our stop at 7229, 10 pips below the lower low. And as the next candle closes, we'll see we have two candles again, each with a different low. The lower of those two lows is 7274. So our stop will be 7264, 10 pips beneath the lower low. And so on. We carry on with this, and we have two candles. The lower of the two lows is 7309, so our stop is 7299. Then a funny thing happens. We have two candles, but the second candle has a lower low than the first. Watch how this changes things. Out of these two candles, the lower low is 7317, so our stop is 7307, 10 pips beneath the lower low. Now, as the next candle closes, you'll see that the lower low of these two most recently closed candles is still 7317, so we cannot raise the stop yet. And of course, we're never going to lower the stop under any circumstances because we're long. And you can see that as the price continues to rise, we trail the stop higher. Now, the lower low of the two most recently closed candles is 7398. Our stop is 7388. And so on. Now, if we're short, we simply reverse. In other words, we're going to place the stop 10 pips above the high of the two most recently closed candles. And as each subsequent candle closes, we will recalculate the high of the two most recently closed candles. If the new two-bar high is lower than the previous two-bar high, lower the stop so that it is located 10 pips above the new two-bar high. So we're short. Obviously, we just want to lower the stop. And of course, since we're short, we're never going to raise the stop under any circumstances whatsoever. This brings us to the parabolic SAR, or stop and reverse method. Now, parabolic SAR is not just an indicator, it's actually a complete trading system. It's telling you where to enter, where to place your stop, where to exit. Now, this is designed as an always-in system, meaning that the trader is always in the trade. He's always either long or short. The indicator was created by J. Wells Wilder, who also created the Relative Strength Index, or RSI, ATR, Average True Range, which we've used before, and of course ADX and other indicators as well. This particular indicator, parabolic SAR, is intended for use in trending markets, and the SAR stands for stop and reverse. Now, the current location of the stop is indicated by a dot on the chart, and as each candle closes, the stop is moved closer to the price. The indicator actually calculates how much farther to move the stop for each closing candle. When the stop is hit, the trader reverses direction. For example, if a trader is long and the stop is hit, a short trade is immediately entered. What we can see here, you see that the dots on the chart alternate. Sometimes they're above the price, sometimes they're beneath the price. Now, obviously, when your stop is above the price, you must be short. And you can see that when you're short, the dots trail lower and lower until the price touches them. Now, once the price reaches the dot, that's the price hitting your stop. The trade ends at that point, and you immediately flip from either short to long or from long to short. So if you're short and your stop is hit, you immediately go long, and you can see that now the dots are underneath the price. And as the price rises, the dots trail higher and higher until, of course, once again, eventually the price will hit the stop, and at that point, the trader flips from long to short. On this next chart, we can see that parabolic SAR can be used on an intraday basis as well. Now, recall that we said that it was an indicator that is intended for use in trending markets. Now, isn't it true that intraday, there are many times of day when the market is very flat? And because of that, during certain times of day, a trader will almost certainly be chopped up, as we say, if he's using this technique. For example, if you look at the left of the chart, this trader is going long, short, long, short, long, short, and the price isn't really going anywhere. So this trader is really just chasing his tail. Then eventually, there's finally a breakout, and you can see the price races higher, and the stop trails up underneath. Then there's another choppy section there at the top, and then a sharp decline, and the price races lower, and you can see the stop trailing down above. So on an intraday basis, it's okay to use this, but just be sure that you're not using it during a time of day when you know that it's highly unlikely that the markets are going to be moving. Because as we said, if you use it during those particular times of day, you're very likely to be, as we say, chopped up in the trade. On this next chart, we're looking at a trending market. This is the downtrend in US dollar, Canadian dollar. And you can see there's a nice long stretch there where parabolic SAR has the trader short. Now, one of the things I want you to notice is that on this particular case, in the daily chart, the trader's short for quite a while, maybe a month. Now, most traders are not going to hold a short trade for a month. But look at the amount of money that would have been made if one did have the discipline to do this. So, let's not discount the idea of holding a trade for a long period of time if it's trending. Because obviously, if you're on the right side of the trend, the longer you're in the trade, the more profit you've accumulated. Finally, I want to take a look at a chart where we can see the trailing stop accelerating. If you look in the center of this chart, you'll see that the price rises very rapidly, and you'll notice that the dots spread out. In other words, the stop is chasing the price higher. So when the price accelerates, the stop accelerates behind it. That's one of the beautiful things about this technique. It's designed that way so that, because it's based on volatility, when the market becomes more volatile, the stop moves more quickly. When the volatility decreases, the stop moves more slowly. And that's about does it for stop techniques and stop placement. I just want to say in summary that you should use a variety of stop placement methods to confirm your stop. You should always place your stops within your risk management parameters, and if you're not sure what those are, please review the section on risk management. And, of course, we are always going to reject trades that create excessive risk. In summary, I'd like to say thank you from FX Educator. Again, my name's Ed Ponsi. It's been my pleasure and honor to be with you today. I hope that you'll find the information very useful, and I also want to thank FX Street, the sponsor of the DVD. Hope you've enjoyed our presentation. Please feel free to contact me at www.fxeducator.com. Thank you.